Can y'all hear me? Can y'all hear me? Hello, hello. All right, perfect. Perfect. Uh, uh, hmm. Uh, Hello, hello. Hello, hello. Sorry, guys, I'm trying to really understand this. This took forever, but here we are, day three of learning how to day trade. I'm gonna record everything from boring to not boring to just everything. And we are just going to learn how to day trade. So, yeah, that's where we're at. So, let's begin.
Knowledge is not understanding. I can tell you that E equals mc squared, but what the heck does that even mean? Even if I say what those letters stand for, I still don't really understand it. So, I'm doing this presentation because it will benefit my own learning experience, and hopefully I can help you as well. This presentation is the accumulation of well over 50 hours of watching videos, since 99% of trading information is garbage. It took over 50 hours to find just a few hours worth of really helpful videos. Sorry for the rambling.
Imagine being able to build anything just by thinking about it. Meet Base 44, a complete AI creation platform made for anyone with an idea and a drive to bring it to life. Describe what you want and watch it take shape. You can plan, customize, and expand in any direction. From tools built for one to platforms ready for many. From passion projects to enterprise-grade systems. Everything is built in and ready to launch. It's a new world of creation.
Let's do this. So, very briefly, let's go over the only part of supply and demand that helps us understand trading. For both buyers and sellers, there are prices that are desirable, and there are prices that are undesirable. There is no need to make it more complicated than that. I stop buying ice cream when it becomes $5 a quart, and I start buying it again when it goes down to $3 a quart. When price gets too high, the big institutional traders who actually move the market start selling, and when it gets low, they buy back in. The people who have enough money to actually move the market are not looking at 30-second or 1-minute charts. They're looking at the bigger time frames, waiting to get a good deal. Remember the law of supply. The higher the price of something, the more sellers will sell it. Smart money is not buying huge positions at an all-time high. Why would they do that when they could just wait a week and buy it for a much better price? Remember, when demand exceeds supply, it goes up. When supply exceeds demand, it goes down. All that means is that when it gets to a good buying price, big money steps in and chews through all of the sell orders to drive it up. When it gets to a good price to sell, there are more sellers than there are buyers, which causes the price to go down. The cool part about this is that we can use volume profiles to actually see how the quantity of trades is changing at different levels of the market. Remember, do not let the stock market terminology confuse you. Almost everything is simple, and the only thing that can make the market seem overwhelming is because it's a new language. There are all of these fancy words that economists files to actually see how the quantity of trades is changing at different levels of the market. Remember, do not let the stock market terminology confuse you. Almost everything is simple, and the only thing that can make the market seem overwhelming is because it's a new language. There are all of these fancy words that economists steps in and chews through all of the sell orders to drive it up. When it gets to a good price to sell, there are more sellers than there are buyers, which causes the price to go down. The cool part about this is that we can use volume profiles to actually see how the quantity of trades is changing at different levels of the market. Remember, do not let the stock market terminology confuse you. Almost everything is simple, and the only thing that can make the market seem overwhelming is because it's a new language. There are all of these fancy words that economists and big money traders like to use, but remember, no matter how complicated the formulas are for creating indicators for technical analysis, and no matter how many lines of code are being used for a computer that does trading automatically, almost everything boils down to buy low, sell high, and sell high, buy low. Of course, you can make things more complicated by shorting implied volatility or going long on implied volatility with options, but that's irrelevant. And the point I'm trying to make is that no matter how many new words there are to learn and how overwhelming it can seem, all of the concepts in this style of trading are very easy. It's so confusing to me when I hear all of these internet experts talking about how we need some edge or new system to be profitable. How about I just follow what's happening instead of trying to write some VWAP moving average stochastic RSI overbought oversold formula which incorporates data from the chicken market since I found it to have a positive correlation with the S&P 500 on the first Tuesday of every month except for February. Come on now. We don't need to do that. The only thing we need to know is how to follow in the shadow of the people and the computers that move the markets. Isn't it much easier to point at a chart and say, hey, look at that. The price is stalling out where it went up really fast yesterday. Let's go long here and see if it happens again, and just set a stop loss directly below the low for a tiny risk and big reward. Let's very briefly mention our risk-reward ratios. A 1 to 3 risk-reward ratio means that you are either going to take a loss of 1 point or win 3 points. For ES, the futures for the S&P 500, this means that you are risking $50 to make $150, since 1 point has the ratio. Let's go long and say, hey, look at that. The price is stalling out where it went up really fast yesterday. Let's go long here and see if it happens again, and just set a stop loss directly below the low for a tiny risk and big reward. Let's very briefly mention our risk-reward ratios. A 1 to 3 risk-reward ratio means that you are either going to take a loss of 1 point or win 3 points. For ES, the futures for the S&P 500, this means that you are risking point reward ratios. A 1 to 3 risk-reward ratio means that you are either going to take a loss of 1 point or win 3 points. For ES, the futures for the S&P 500, this means that you are risking $50 to make $150, since 1 point has 4 ticks, and each tick is $12.50. This also means that it would take 3 losses to wipe out the profits of 1 good trade. For supply and demand trading, the strength is that it has really well-defined risk and really well-defined profit-taking levels, so you don't need to have a super high win rate for it to work. For the chart on the right, you can see that even if we change our risk-reward to be very conservative down to 1 to 2, to break even, we only have to be right 1/3 of the time. Now, let's do a little lesson on the relationship between anxiety and trading. Anxiety in everyday life usually stems from feelings. Lesson on the relationship between anxiety and trading. Anxiety in everyday life usually stems from feelings of uncertainty. What's going to happen tomorrow? Did I forget to turn the stove off? What if these people don't like me? Are they huggers or do they prefer handshakes? All of these questions are relatable for people with generalized anxiety and social anxiety. This anxiety, whether it manifests as shaking, sweating, faster heart rate, or sickness, is stemming from cognitive processes about the unknown. We fear the unknown, and we also worry about it. We don't know if the elevator is going to work, we don't know how fun the party will be, and we have detrimental thought processes which have physical manifestations. So, how does this relate to trading? I had anxiety about trading when I was scalping Tesla options. It manifested as shaking, stomach pain, an increase in heart rate, and more. This happened because my plan was never really that clear. I had a plan, and I traded the plan, but there was so much mysteriousness and guesswork going on that I never really felt that confident. Now that I'm looking at trading the S&P 500, supply and demand imbalances don't make me feel like that. These setups have a clear risk and reward, a set stop loss, and a set profit-taking level. Anxiety about trading implies a lack of confidence. If we can remove as many variables as possible when we take a setup, we can reduce that anxiety. The solution to reducing trading anxiety is to find a strategy that you can be confident about, and then use the computer to execute as much of the entire order as possible. Remove human error and human emotions, and your thesis about a trade will be optimized.
Introducing Iron Beam, a bright choice for futures trading. Iron Beam is an industry-leading.
Let's take a look at this chart I borrowed from the internet. We short at supply zones, and we go long at demand zones. The green rectangle is the zone that we want to short at.
Yeah, literally, like what?
So let's see how we created it. For supply zones, the bottom of the rectangle starts at the open of the last bullish candle before the drop. The top of the zone starts at the most recent high before the drop. If your intuition has told you, but that's just waiting for a bounce off resistance, yeah, you're kinda right, but it's more than that. You never would have gotten in on this trade if you were waiting for a bounce off of resistance. However, we knew that this was a trade signal to take it short after it left the supply zone. For demand, the bottom is the most recent low before the big move up. The top is the open of the last bearish candle. Here is another example. And here's one more. The candle you're drawing the demand zone off of must be bearish. If it happens to be bullish, you need to go back and locate the nearest bearish candle before the move up and draw your rectangle from there.
Uh, uh,
This is for the top of the demand zone. Now, I don't know how valid this statement is, but it is important because we don't want to take a trade that has already moved a lot. There is a good chance that it's going to turn around, which is why this strategy is good for finding out when those turnarounds, aka reversals, are going to happen. Also, part of the idea that this strategy is based on is order flow. The price comes back to a zone that it once left very quickly, and, when it returns, hypothetically there are still leftover orders sitting in that zone that will drive the price out of there just like it did the first time. So, you can't just keep coming back to a zone and reversing. Eventually, those orders will be chewed through. Also, let's keep in mind that support and resistance lines are still valid, so just because a zone may have lost its power, it doesn't mean that there won't be more battles going on at important price levels. It may reverse again, but not because of leftover orders. This picture on the right is just so you can see that if we wait for confirmation that the price is going to leave the zone, we can take profit right below or above the next zone. For example, I see that price is leaving the demand zone at the bottom. I set an order with a profit take, one tick below the entrance to the supply zone, and maybe I set my stop loss just below the entrance to the demand zone. This would be super safe, but maybe I want to get out if this isn't a move that immediately goes back up. Now, ignore the picture and listen to these important notes.
This right here is where great ideas go to die. Not because they were bad ideas, but because the person who had them.
Lots of small consolidation with a small breakout is not a strong setup. Huge moves are from institutional influence, and those are the levels that matter to us, because they are the ones who make the big stuff happen. Additionally, we can use volume profile to show us the price levels where the most volume is happening. So, we can volume profile the supply and demand zones to see where all of the action is happening. I'm waiting for TD Ameritrade to finish the paperwork for my account so I can use Thinkorswim for charting, since it has all of the good tools for analysis. Also, Trader Workstation with Interactive Brokers is absolute garbage for charting, but I'll still be executing my trades there. This is quantifying order flow imbalances. You can see where the sellers are. If this top supply zone can be broken, then you know that the next zone is going to be tough to break through. And it will only get harder, because the further up the price goes, the more attractive the price will become to sellers. When you have an established plan before the price gets to this zone, you are trading proactively instead of reactively. I'd also like to note something that I think is important here. What we are looking at is an opportunity to buy where that circle is on the far right, expecting it to get close to that first supply zone. Do you see what I see though? If I took this trade, I would have looked to take my profit if the price didn't almost immediately break through that resistance line I just drew. If it does get through, we would look to see if it could get through that zone, and then we would just keep on holding until it failed to break a zone. Let's take a look at one of my new favorite phrases. Don't diddle in the middle. Catchy, easy to remember, and smart. What kind of magic indicator is going to tell me what I'm supposed to do with a statistically significant level of accuracy during this choppy stuff between these two zones? VWAP? No. 9 EMA? No. The only way you trade chop that looks like this is with a good risk to reward ratio and just start guessing. However, after we drew this green zone on the bottom, if we wait for price to leave and go long, taking our profit right before the supply zone, that's a big win. We don't need to win that often for this to be a good strategy. Remember, Don't diddle in the middle, because when the market gets choppy, trading gets sloppy. There's another one for you. Now, a brief intermission. Let me just remind you that this presentation is happening because teaching something, in your own words, is the best way for the human brain to store information long term, and I might even teach you something or spark an idea that leads to you improving your trading life. I haven't even done a single trade with this yet, and let me also make something clear. We're not going to see an A+ setup every day. In fact, maybe just 3 times a week we will see a great setup, but the methodology is so good that this is all that we need to become consistently profitable. More trades don't equal more money. Perhaps, 1 week from now, I will have different opinions on supply and demand zones and the other technicalities involved here. Okay, let's get back to it. What are these zones created from? Peaks and valleys, which are just another name for market turning points. Peaks refer to the top of the area where price turns to the downside after a move up. They become areas of supply and are created by a rally base drop formation. We've got some new vocab here, but take it easy. They're self-explanatory. A rally goes up, a base is the consolidation where it just hangs out for a bit, and the drop is, well, the drop. It would be easier just to call them up, sideways, downs, but we all know that if it has something to do with the stock market, we have to give it a special name to make ourselves sound smarter than we really are. Valleys refer to the bottom of the area where price turns to the upside after a move. We all know that if it has something to do with the stock market, we have to give it a special name to make ourselves sound smarter than we really are. Valleys refer to the bottom of the area where price turns to the upside after a move down. They become areas of demand and are created by a drop, base, rally formation. Yep, you've got it. That just means down, sideways, up. The strongest setup is going to start from a huge and fast move, and you should ask yourself, don't you think we left some buyers there? If it moves super fast, there wasn't enough time for these big orders to get filled. So, when it returns to these zones, why should we believe that it won't get bought back up and rally again? I'd also like to note that these 2 demand zones are based off a zone that isn't in this picture. It's from the previous slide, so if you notice that the second zone actually goes below the low of where the arrow is pointing and thought to yourself, wait a minute, that just broke through the demand zone. Great job paying attention. Rally base rally refers to a continuation pattern controlled by the bulls. This can act as an area of demand for upcoming trade setups. If the price comes back to this base, it would be a good idea to get long here. If the price comes back to this base, it would be a good idea to get long here. Drop base drop refers to a continuation pattern controlled by the bears. This can act as an area of supply for upcoming trade setups. So, if the price comes back up to the base, it would be a good idea to get short here. Let's also remind ourselves that this formation just looks good to go short after it breaks the consolidation/base. Flag patterns and pennant patterns are very high probability.
Thinkorswim is the most powerful free trading software if you use it to its full potential. I've been trading now for over 10 years, and I have a college degree in computer science. So I built something to save traders like you.
We have to remember not to overcomplicate how easy it can be to make money when it's in a clear down or uptrend. Larger time frames are more important because that's what big money is paying attention to. They are more aware of this stuff. They don't care about some weird technical analysis baloney, like an inverse triple waterfall, butterfly swordfish guitar pick, or whatever you want to call it forming on the 200 tick charts. If we want to make big money, let's follow what big money is doing. And we have an amazing advantage over them, since, individually, our orders don't influence the market. We get all of the benefits of riding those huge waves they create without actually causing any ourselves. Now, on the charts, we do a top-down approach. This begins with the larger time frame first, and then we work our way down to the time frame we will be placing our trades on. Some helpful information is, choose a maximum of 3 time frames to view, and do not overanalyze the market. Do not look at 10 different time zones or you'll psych yourself out. All we need is the daily chart, hourly chart, and then the 5 or 15 for our entries. Less than that is all noise and stuff we should not care about. We want to know what kind of trend the market is in overall, and then we want to know what it's doing this week and today. It does not need to be more complicated than that. The 5 and 15 are best for supply and demand. Remember, the more the price drops down, the less desirable that price becomes to the sellers, so why would we not believe that it's going to come back up? Simultaneously, that price becomes desirable to the buyers. You don't want to become a buyer after a large rally, and you never want to become a seller after a huge sell-off. Okay? Let's do an analogy to surfing. I've never surfed, but the concept is not difficult. However, if you get on the board at the very end of the wave, I'd probably tell you that you suck at surfing. We use supply and demand zones to identify where these big waves are building up, and then we ride them to their destination on shore. And when we get back into the water, we have a general idea of where another wave is probably going to start again. So we wait there patiently and ride it again. Let's briefly return to my favorite phrase. Don't diddle in the middle. When it's choppy, you'll have a hard time convincing me you're not just gambling with good risk management if you're diddling in the middle. Yes, by definition, all trading is gambling, but hopefully you get my point. We have no idea which direction has higher probability in the middle, but when it's in a supply or demand zone, there's a good probability as to which direction it will move. Now, I like this picture for a few reasons. This is ES on the 5-minute chart, which is the futures for the mini S&P 500. You can see that we will have big trading opportunities and smaller ones. It dipped into that demand zone that I drew, so we could go long there. Then, we would have sold it about 25 minutes later after it got up to the high of day and failed to break through it. Now, that was only a few points, but it was still a clean setup. These are the only patterns we need in order to trade. Reversals have a rally-based drop and a drop-based rally, where base becomes the zones to trade, and the other ones just have a small base where it stalls out before continuing to move in the original direction. The continuation patterns create supply and demand zones at their base as well. The speed at which price left the area determines the strength of the imbalance in price. We don't want to see a bunch of little candles. We want to see a few big candles, which you can see on the left. The faster it leaves an area, the higher probability the price will turn there again. This is a very good demand zone because of how fast it left. You'll notice it didn't stay there for very long either. Now, the supply zone isn't that good because it moved very slowly, so it wouldn't be a good idea to short when it got back into that area. If price arrives into a level with few candles, which just means fast, price is offering a larger profit potential for upcoming trades. This is due to no opposing order flow being close to the entry, which is just saying that not a lot of people want to sell right there. But they do want to buy. So, let's just follow them and make some money. If price enters the level very slowly, there's a higher probability that price will continue in the current direction.
What if you can create your own website by saying, this is what I want? With Wix, you can. First up,
This is very important, and, in this case, it is referring to the speed at which the price enters a supply zone. It is saying that the faster the price jumps in there, even if it was consolidating in the middle for a while, the stronger the chance is that it will reverse out of the zone. Let's look at an example. See how fast it returned to the supply. Let's look at an example.
Oh, so basically, um, if it goes up really fast, there's a chance that it's gonna go down really fast. If it goes up very medium, like this, like it went up really fast, so there's a chance that it goes down. And this one medium, so it goes medium, and then
See
yeah.
how fast it returned to the supply zone at those two candles? That's what's important.
Mm, this is the demand. There's high demand. Whoa, that's crazy. Hold up, I can't see. Okay, interesting.
We don't care about all of the choppiness after it left supply and before it got to the two candles that went flying into the zone. It can move around like this. What's important is how it eventually moved in. Here, it did it really fast in just two candles, so it's good. We can call this a clean arrival. The less time it spends at good. We can call this a clean arrival. The less time it spends at the base/consolidation, the stronger the level is. It shows a clear decision and no battle. If it leaves very fast, then the chance of orders being left in that zone are higher. If it's at the base for a long time, there's a good chance that order flow is already consumed. So, when we return to the level, the probability of it holding is lower. Remember to ask the question, don't you think we left some buyers there? This is a good base. It went in, and then immediately rallied out. Even though you'd like to see it leave this zone faster after it came back, the buyers are still in control. This is a good setup, but sometimes we have to be patient, which is something
Mm. Uh,
I personally have to work on. That's why we set the stop loss one tick under the demand zone. Now, I want you to look at this chart and see if you see another clean setup. I'll wait 5 seconds.
Imagine being able to build an app with your name on it, just by thinking about it. Meet Base 44, a complete...
right here, no?
Do you see the supply zone up there? That's a great looking setup. Remember that we need to be aware of the overall trend of the market. Something you may have also noticed is that not everyone makes these zones the same. I made this one by extending the rectangle from the opening price of the last bullish candle and the most recent high. Some people use percentages of the first candle out. Let's also remember that we need market context to make judgments about whether our zones are going to result in the movements we are hoping for. Not every zone is going to work, of course. This isn't a magical indicator, and I'm not selling you anything. I don't even know how to actually do it yet. I'm just making this to quantify my own research and to make use of my notes. Notes aren't useful unless you use some sort of method to commit them to memory. Let's talk about actually doing the order from start to finish. Let's say the price has dipped into the demand zone at the bottom, and it has now just barely left. I will buy one ES futures contract, and, by the way, this strategy seems to do well with all forms of trading, since supply and demand is a fundamental part of all markets. My profit target is going to be right below that supply zone, and my stop loss will be one tick below the demand zone. That's very small risk for a great reward. Additionally, if I'm right, I'll probably drag that stop loss up as time goes on so I can at least lock in some profits or break even. Of course, this would be the opposite process for selling a supply zone or shorting the market. One thing that we need to watch out for when going long are resistance levels between demand and supply. These levels are still significant. And when we short the market, we need to watch out for support levels between the zones as well. Remember, we're going to be wrong sometimes. We need market context to have better informed decisions. It's really easy to get a picture where the strategy works. And something I have to remind myself is that this isn't the be-all, end-all of trading. I'm sure I'll find something else on my own or from someone else that makes a lot of sense, which I can add to my arsenal of trading strategies. In the markets, we need to be adaptive. Survival of the fittest extends to every aspect of life, including economics and the market. It's easy to see Darwinism at work in the markets, and the statistics about how many day traders fail exist because of the failure to adapt. Adapting is what I will do until I can do this successfully. I'm never going to give up, because even if there was only one person who could do this successfully, then that's good enough for me to persevere until I become the second one. There are so many ways to make money, and, as the only animals on Earth with a sense of self and an often destructive
Bro, that would have been a good short. 20. I could have closed profit right there. Shit.
ego, we love to overcomplicate things. We do not need 50 magical indicators or a million petabytes of data run by a building full of supercomputers running statistical.
Oh my goodness. This would have been a beautiful trade. Wow. Uh, I would sell at that point. Yep. If I wouldn't have closed there, it would have just been gambling for sure. Oh, look at that. And then if you place it long, you're also gambling. Let's see what else. All right.
Analysis.
So my takeaways are, in terms of supply and demand trading. Oh shit. I just finished.
Not a single one of these patterns or systems.
Wait, what? DTS.
so pissed off right now. You guys don't know what's boiling in my blood. I'm so pissed off right now, guys. I'm so pissed off. How am I up 125,000 and I just blow $66,000 in one day? How do you lose discipline?
Work long term.
Damn, bro. I just spent like 40 minutes on this video. It turns out that it's supply and demand doesn't exist, I guess. Fuck.
Your future is at your fingertips. Take advantage of the flexibility and diversity of future.
Hi, how are ya? You ever wonder what your brain is doing while trading? No? Well, you should watch this anyways. I bet you'll be pretty surprised at some of this stuff. Alright, you've heard of dopamine. It's a buzzword, it's overused, your friend thinks they're being clever when they say it instead of happiness, and it's a neurotransmitter in our brain. We have many different kinds. We do anything that's considered rewarding, like eating food. Reward is uncertain. Sounds a lot like trading to me. I realize that this machine here is for balancing, but just pretend that the balance represents an event, and one of the two possibilities is going to happen at any moment, so the picture represents how reality is going to point to one of two binary events at any moment. The analogy doesn't really make sense, and a different drawing would have been better, but I already drew it and I like it, so it's staying. With an addiction goes to take that drug. The area of their brain that is lighting up is the exact same area that lights up when we take a trade. Now here's the worst part. For many people, not all, but many, when we lose on a trade, our brain still releases dopamine. Not as much as winning, but still. That's messed up. That's like getting a trophy for losing. The result of this is that it gives us the urge to keep trading. Our brain chemistry is our enemy when we lose, and this is part of why revenge trading is such a problem for some people. I know it looks like he's flipping off the brain, but it's supposed to be him shaking his finger while yelling at it for misbehaving. Your brain is encouraging you to revenge trade, but through time and exposure, we can cognitively overcome that urge. You don't act out every urge you get, and wanting to take a trade is just another urge, so you can overcome it if you stay disciplined. Of course, that's assuming you don't have the impulses of a 9-year-old. Did you know that in electronic gambling machines, they take advantage of this and trick your brain into using them more? They set up games so that when you lose, it looks like you're going to win, and then it barely switches to something incorrect, which results in a loss. This tricks your brain into responding as if you won, which makes you want to play more. This drawing is supposed to show a wheel, and the pointy thingy is about to land in the money zone, but the wheel holds on and the pointy thingy ends up in the spot where you don't win money. Kind of like in the Wheel of Fortune computer game when it's about to land on 1 million, but then it snaps into the bankrupt zone. So, for scalpers who are trying to make, say, 20-second plays, when something barely misses your take profit and then you get stopped out, on a biological level, your brain is going to be your worst enemy. These near-miss, almost wins are used everywhere at casinos, and it's part of how they manipulate people into continuing to gamble. That's it. But if you want to briefly educate yourself on the structure and on the process of how neurotransmitters work really quickly and easily, I promise I can do it in a way that is much simpler than your high school teacher. Yeah, the one who thought he was the smartest guy in the world and pretended to like dopamine to do this. Neurotransmitters bind to receptors on the dendrites of a neuron. Dendrites are how these messages on is the tube that carries out multiple neurons with multiple connections. In other words, it's all connected. The synapse is the chemical junction. In some ways, it's like the sky, and interactions happen there, like planes and
Introducing Iron Beam, the best choice for futures trading. Iron Beam is the industry.
whatever ado means. Let's distinguish between supply and demand and How are you? This one's not going to keep you on the edge of your seat with excitement, but I would argue that what I'm going to talk about is the foundation on which almost every aspect of our emotions and of trading psychology are based. I've attained this knowledge through my college psychology classes, where I have a 3.9 GPA. If we're only counting psychology, I have a 4.0. I say this to ensure that you can trust the validity of these scientifically proven concepts, and, as someone who is about to become a social worker, I assure you that I'm here to help, and not to get you to buy a course. The video will be time-stamped with different sections, but I obviously recommend that you watch everything if you are serious about improving mentally as a trader, which many argue can be more important than the actual trading system. I believe that all of the videos I make are important, because that's why I make them. But this one may be the most important so far, due to it being so fundamental to the human experience. Okay, enough chit-chat. The real-world applications and the potential of cognitive behavioral therapy, or CBT, is something that I find to be incredible. Part of what it does is that it aims to explain how you and I can both experience the same event, but interpret it completely differently by showing how our thoughts influence our feelings and our behaviors. Two people take the same losing trade. The first guy is miserable and is losing hope at his ability to be consistently profitable. Meanwhile, the second guy says to himself, "That was unfortunate, but that's how trading works." He brushes it off and moves on to the next setup without being bothered in the slightest. How does this happen? What is happening in their brain that causes the difference between them reacting to the same experience? I promise that everybody has something to learn from this, and there are many of you who will find this more helpful than any trading guide or price pattern video if you really allow yourself to be open to this information. Okay, let's get right to it. The ABC model explains the interactions between our thoughts, feelings, and behaviors. A is the activating event, and we will use losing $100 on a feelings, and behaviors. A is the activating event, and we will use losing $100 on a trade as an example. B is the belief, and this is what we believe about the event. This belief is the part that is unique to each person, and it is the belief of the activating event that was different between those two traders who reacted differently to losing a trade.
Get 50 grams of protein. Lose the chalky aftertaste. Factor makes hitting your protein goals easy and actually delicious, with meals packing up to 50 grams of.
Here's a not-so-fun fact for you. Someone who's depressed is more likely to interpret an event as negative, and someone who isn't is likely to interpret the event as neutral or as positive. So, after a loss, someone whose mental health is doing well is more likely to believe that it was a good learning experience, while someone with depression is more likely to come away from that trade feeling angry towards themselves or feeling some other types of negative emotions. This is taught in therapy because awareness of how our thought processes and emotions affect each other is how we can begin to challenge these negative thought patterns. C is the consequence of the belief, which includes how we feel, our emotions, and what we do, our behavior. For that first trader who lost, he feels hopeless and emotional about losing, and, as a result, his behavior ends up causing him to be more hesitant about the next trade. So he sets a stop loss at the amount he is willing to risk, rather than at a level that makes sense, like a pivot high or low. And because of this, he gets stopped out right before the price moves in the direction he thought it was going to go. This compounds his hopelessness and his fear, and it is a vicious cycle. Enough of the basics, let's get to the part where we fix it. We can't change the event, because we can't manipulate the market, to an extent. However, the events that we can avoid are not taking trades where the only logical stop loss is really far away, and we can also avoid bad setups that we only want to take because trading is fun. That leaves the belief in the consequence, and since the consequences are caused by the belief, it obviously makes the most sense to try and change our belief about the event. A learning mindset is crucial. I would even go as far as to say to try and change our belief about the event. A learning mindset is crucial. I would even go as far as to say that for beginners like myself, doing a trade without thinking about what we learned from it is a guaranteed way to fail. Everything that we do is to learn more and to become better. In CBT, one of the best ways to challenge beliefs is by asking yourself, is there actually evidence for this belief? Do you struggle with thinking that you can't be successful doing trading and you've only been doing it for a few months or even less than a few years? All of the people that I respect who are successful traders took several years to become consistently profitable. So, are you actually being realistic when you have negative thoughts about yourself and trading? When you lose a trade, is your belief that the market is rigged, that the system is designed to make you fail, or that your stops are being chased? That's a bunch of baloney, although there are some situations where stops may actually be hunted. But I promise you that some guy at Goldman Sachs didn't move the entire S&P 500 down 1 point just to specifically take out your stop loss before rocketing up 100 points. That's a topic for another video though, since there are some circumstances where stopping out a bunch of people at an obvious price level can give big traders the liquidity that they need. Challenge your beliefs. Is there evidence to support how that they need? Challenge your beliefs. Is there evidence to support how you interpreted an event? Is there an alternative explanation that makes more sense, but maybe your emotions are clouding your judgment? Our behavior after a trade is crucial. If we mess up, and then try to avoid the situation again, which we knew wasn't guaranteed to work, we will miss setups. We can't always be right.
Hey everyone, in this guide we're introducing our new AI indicator which we developed in partnership with OpenAI. This is
A system can only be proven to work if we try it multiple times. If we always skip around and try something different because of one loss, we will never become successful because there is nothing that works every time. This is a mindset that I used to have, and someone helped me out with this problem by telling me that I needed to give it more time. Everybody sees the world through a different lens. My beliefs about myself, about others, and about the world are different from yours, and this causes us to interpret events differently. Part of helping people with something like depression is to challenge the core beliefs that we have about the world. These core beliefs define who we are, and they guide how we live our lives. If you are someone who thinks the world is against you, you may feel anger or resentment towards the markets after a loss. This core belief has to be addressed. CBT is not about changing all of your thoughts into happy ones. It's about questioning the validity of unrealistic or irrational beliefs. It's okay to not think that the world is a happy place, and it's okay to think that the stock market is unfair or brutal. It becomes not okay when your belief that the world is against you causes you to think that your trading success is not dependent on your own efforts. You are in control of your learning process, and you have to take responsibility for everything that you do. This is the locus of control, and I almost made a video specifically on this, but it would have only been like 2 minutes long, so I decided not to. An internal locus of control describes a person who believes that their destiny is in their own hands. They believe that what happens in their life is up to them. The success of your trading career is up to you. Just because others around you have failed does not mean that you can't do it. There are a lot of negative people who are bitter about day trading because they could not succeed, and they think that it is impossible to do just because they couldn't do it. They project their own issues onto others, ignore them, and try to feel bad for them rather than take their attacks personally. This is what I do because that's how I'm wired, but I understand the urge to respond with their level of bitterness. If everything in your life feels out of control, grab onto something that can't be taken away from you. Some people really do live chaotic lives and are born into horrible circumstances, but most people think that they aren't in control of what happens to them because it is the easy way out. It requires less effort, or it is a core belief that may stem from low self-esteem or some other factor. Either way, it is possible to change this part of who you are. It is not some physical part of your brain. It is an attitude and a perspective. This section is about cognitive distortions. This has everything to do with trading, but it's not as directly of who you are. It is not some physical part of your brain. It is an attitude and a perspective. This section is about cognitive distortions. This has everything to do with attitude and a perspective. This section is about cognitive distortions. This has everything to do with trading, but it's not as directly applicable as some of the other things I've said, like how I recommend doing chart trading so that you can automate your order to reduce anxiety. But how can we be the best versions of ourselves, and therefore the best traders we can be, if there are parts of our mind that are bringing us down? Some of these are more important than the others, but let's get right into it. Emotional reasoning is when you believe something is true because that's how you feel. Does that resonate with you? Do you know anyone who is scared of planes but not cars, even though you're statistically more likely to die in a car? Sometimes we feel a certain way, so we believe it to be true, even though the facts completely disagree. That's being out of touch with reality, which sounds extreme, but we do these things every day, and almost everybody does them. Our brain can be very mean to us sometimes and make us feel low about something, even if people from an outside perspective would be completely confused by how obviously wrong it is. Just because we feel like the market is going to go up today does not mean that it's true. Just because we feel like the price is going to bounce back, it does not make it true. For example, there are so many people who feel like they are fat, even though their weight reflects a perfectly normal BMI. For those of you who may be overwhelmed by trading, or you recently took a loss and you're thinking about quitting, those feelings do not mean that you can't handle it. It can be overwhelming, which is why many people give up. Many will take that as a sign that what they're trying to achieve is too much for them to handle, but complying with this urge is what caused that statistic of 95 or whatever percent of traders failing to be so high. But now we know that emotional reasoning is a cognitive distortion. Logically, it does not make sense. And remember, this is not about belittling emotions or about minimizing someone's experience. It's about thinking objectively and factually, rather than thinking and acting with our emotions, which often mislead us. It's not about dismissing how we feel. It's about recognizing when we have beliefs that do not logically make sense. Disqualifying the positive is something I can relate to when I used to play high-level soccer or football for everywhere else in the world except for where I am. This is when we ignore the positive aspects of a situation and we overfocus on the negative. Did you go a couple weeks making a bunch of awesome trades and feeling good about yourself, and then you blew away all of those profits with one bad trade? It's when we have beliefs that do not logically make sense. Disqualifying the positive is something I can relate to when I used to play high-level soccer or football for everywhere else in the world except for where I am. This is when we ignore the positive aspects of a situation and we overfocus on the negative. Did you go a couple weeks making a bunch of awesome trades and feeling good about yourself, and then you blew away all of those profits with one bad trade? So you had 15 good or at least neutral events happen to you, and all you can focus on is the one bad thing? It doesn't make any sense, but it's what we do. I used to leave a soccer game after having a great game, multiple goals, assists, and good plays, but I would be thinking about the one or two plays that I messed up. Now that just doesn't make any sense. Why should I have ignored all of those awesome things that I did while only focusing on the one thing I messed up? So, be easier on yourself. You may have done something stupid, like what I did with that cash secured put, but what about all of those other great plays? It's part of being human, but sometimes it can be difficult, and it takes a lot of practice, but it works.
Want to break into cybersecurity but don't have experience? The Google Cybersecurity Certificate uses
What if I could build my ideal hiring app with Base 44? Hiring is
All or nothing thinking is our tendency to think of things in extremes, or black and white. Either we are dumb or smart, ugly and like. Catastrophizing is when our mind finds the worst possible explanation for something, rather than focusing on the rule out of something, as if that event can predict all future events. It's a little hard to describe, but people who say things recognize when our mind is playing tricks on us. When we do things like disqualifying the positive, we can recognize those thought processes and challenge them. We can think back at them with challenge questions like, is that really true? Or, is that fair? When we challenge our thoughts, we can begin to change our thinking, which, in turn, changes the way that we feel and the way that we behave. Another thing I would like to make clear is that this is hurting our growth as traders is how we solve our problems. You are watching this right now, so you're already doing way more than the average person who thinks they can just throw money at the market and start trading as a job. Do not give up hope, even when it seems like you are at the bottom. When you try again, you immediately separate yourself.
Fuck, bro. I closed the channel. God damn it. Fuck. Alright. Not good. Okay. Alright, these are all the videos. Be right back.
I know. This month, the very first part of this beginner video talks about
Thinkorswim is the most powerful free trading software. If you use it to its
100% transparency, a free website, and my Patreon contains nothing about how to trade. More on that later though. I'm currently funded but not yet long-term consistently profitable, and I've always made that clear. In March, I took a $2.3 thousand payout, and I'm giving myself a very long time to succeed at trading, because anyone who doesn't watch fake trading gurus knows that you can't get rich quick. I'll talk about myself, my YouTube channels, some very important issues, and how I personally plan on succeeding at trading. So, with a 20% off coupon, I spent $100 to take a trading test that I passed, which meant that this futures prop firm, Trade Day, would then put me on a funded account. If I had then proceeded to lose all of that, I wouldn't have to pay back any losses. I'd just have to retake the evaluation to get funded again. Sounds amazing, right? Except the majority of people will never make it to that position for the same reason that most people lose money playing poker. And yet, there are professional poker players and full-time traders. Let's say you're a golfer. I'll give you access to $1,500 if you can prove that you're good at golf. All you have to do is pay me $100 and score well this round. Obviously, if you're new and have no skills or experience at golf, you're going to fail the test and lose money. I mean, how did you think you would pass? By getting lucky on every single hole? But for good golfers, this is a no-brainer and an amazing opportunity for easy access to more capital. Because look, a prop firm is a tool, and like all tools, can be beneficial or harmful depending on who's using it. A knife can hurt or help you, which doesn't mean the knife is inherently good or bad. Its value is only determined by how each person chooses to use it. You can lose money with prop firms just like you can with a broker because you aren't good at trading and are using real money for some reason, or you can leverage your trading skills and get cheap access to more capital once you've actually developed an edge. And of course, there's people like me who did both. Lost money in the beginning because I was not ready, and now I'm tremendously benefited by prop firms. And I know I'm not ready to trade my own personal account, so firms completely cap my total risk at just the cost of the evaluation. If I learn some new lessons and fail, I just have to get funded again instead of losing thousands of dollars of real money. I say all of this because I'm an affiliate with Trade Day, the firm that I got my payout from. This means I have a coupon for 20% off that I get a commission on when someone buys an evaluation, which I mention every time because that's the law. Anytime I mention it in a video, I always say to never take an evaluation until you're ready, because they're a money pit for bad traders but an amazing opportunity for skilled ones. This is me telling a new trader that they're guaranteed to lose money if they start prop firm challenges too early, and here is an example from a few months ago when there was a sale with Trade Day. Don't just spend money on this just because it's 50% off. You should only be buying an evaluation if you're actually ready. For my Top Step affiliation that I started in order to get access to Top Step X, because it's not public yet, and where I'm now funded, it's just a link and the discount is already applied. I don't think that good traders should be punished for the irresponsible and poor decision making by those who waste money on prop firms before they're actually skilled and experienced at trading. However, doing that is not the complete fault of the trader. In fact, quite the opposite. Prop firms are often marketed or at least viewed by people as a way to get rich quick, and this culture is extremely harmful. It is for this reason that anytime I talk about them, I always say to only buy an evaluation if you're truly ready and have proven consistency, because again, they are an incredible tool for those who are ready, but they are a money pit for those who aren't. Just because some people don't use a tool correctly, it doesn't mean that those who do should be punished. There's nothing more that I can do to ensure the responsible use of these tools than what I already do. Most of the problem is the culture of trading itself, which is entirely dominated by influencers claiming to be successful traders yet have zero proof of profitability. Day trading education is one of the most fraudulent industries in the world, completely dominated by frauds, and the ones who get scammed defend their fake gurus. I'll put the exposing playlist in the top right where each one of these people and more are covered, and those videos are not just little criticisms. We're talking about proof of photoshopped broker statements, stealing day trading courses while asking the owners for help on how to trade and then reselling them, actual fraud, copying popular videos word for word in order to sell beginners a course, and so much more. Nobody has any idea how truly bad the day trading education world is until they see those videos, or have at least been around for a long time. So, of course, there's tons of beginners who lose money with prop firms and call them scams when that is how they are introduced to trading. Almost every trading influencer out here has their own course and/or private community, all trying to tell you that you can make money quickly through trading. The unfortunate reality is that people aren't introduced to trading by first being told that it's not a way to get rich quick, which is what I do. So, just because you can use a hoe to hit someone in the head, which someone did to me as a kid, hey, maybe that's why um, what? Just because of that, it doesn't mean that the tool is inherently bad. All I can do as a public figure is to constantly preach the responsible use of that tool, which is exactly what I do. Unlike many prop firm affiliates, I have never once pretended to be trading with real money or a funded account when I wasn't. I'm on a break from live streaming for now, but I did fully pass the evaluation for my first funded account all while live streaming. My actual trading channel is in the video description. I also just need to bring up the misconception that the trailing drawdown follows you forever. No, that would be horrible. I didn't even know this was a thing with some firms, and I'd never promote one that does that. Obviously, that would be a complete scam and make it impossible to grow an account or withdraw money. That's not how it works. Alright, back to exposing iMan. Honesty, integrity, and the desire to help people has always been done at the expense of monetary gain for myself. I turned down this deal with an offshore broker that would have made me a millionaire in a few years, and yes, that's $20,000 per month before commissions on each signup, and that's just for where my channel was a few months before this current video. In another email, I was told that the high performing affiliates get 50 to 60K per month. The very first part of this beginner video talks about how there's no shortcut to profitability and that I'm going to tell the truth because I'm not selling anything on how to trade. This is part of the reason for so many people closing out of the video so quickly, which again is saying the truth at the expense of losing engagement and therefore money. I have turned down countless crypto broker deals that would have made me a ton of money, and I've also turned down a whole lot of opportunities to scam all of you.
Ready to lose the hat and regrow the hair? With Choose by Hims, you can regain your...
The video on Craig Percoco is now in the top right if you want to see it, but the really juicy stuff on him was sent to me after that video. He deleted all of the unlisted videos after I made this information public on him being secretly paid to promote all of these garbage coins, which is a good time to say that I've never been paid to say something. I've never taken money to make a certain video, and it would be illegal for me to lie about that. Just remember that the only way I could be exposed is if I was secretly consistently profitable, because I've never lied about my trading progress or anything else. Taking the payout I showed earlier is not consistent profitability. Yes, it recoups all of the money I've spent on firms with a whole bunch of profit after that, but it means very little beyond that. What I do know is that all of these fake gurus I call out hate the fact that they can't say I'm just trying to sell my own course or private community. These are disgusting animals with no morals or ethics capitalizing on the dreams of the desperate. To them, I would say the classic line of how do you sleep at night knowingly scamming and ruining people's lives, but that would require them to have empathy. And these fake gurus are either full-blown narcissists, socio or psychopaths, or they've somehow managed to convince themselves that what they're doing is okay. I can say these things because I never grew on YouTube as a trading guru claiming to be profitable. In fact, it's the complete opposite, and I'm just really lucky. Listen to me, I am extremely lucky. I never intended on being where I am now. My channel started as a way to document my trading progress in the summer of 2021 doing the opening range break strategy with options.
Alright guys, so I think it's been good enough time. Um, I'm just gonna end it here. Um, we just watched like a couple videos, didn't really do much. summary is there's supply and demand, there's consolidation, went on the charts, but supply and demand doesn't necessarily indicate true accurate movement in the market. It could just be literally that um, you can't just base that one thing on that. So it's about day three of me learning how to trade. All I did was for 2 hours watch this YouTube videos of this channel, which is the only legit channel I kind of gauge as that I could watch and just follow everything he says. And I just want to get enough tools and things to take from this and then start doing my own without just look at all these YouTube videos I could be watching, but I just want to get everything from this one specific, becoming one trick in the Nasdaq, and then just that's it, you know? So that is it for now. Let me go ahead and end the live stream.